Good morning everyone, welcome to an episode of the Mizuho Week Ahead. I'm Boon Heng, Market Economist at Mizuho Bank. This week's theme is watching out for risks. While everyone hopes for peace, the need to watch for risks is inevitable, be it geopolitics or markets. For one, energy markets remain highly volatile as solutions provided to tame the rise in oil prices remain highly partial and barely comprehensive. The Strategic Petroleum Reserve release still pales in comparison to the sheer scale of oil flow disruption from the Straits of Hormuz. Geographical impediments from various locations of reserves release also imply further delays and compounding shipping costs. Naval escorts being considered by the US does not appear to be ready in the near term, especially if an international coalition is required. In any case, such initiatives do not eliminate the risk of potential missiles and worrying reports of sea mice. Escorted trips across the narrow straits also imply much slower traffic. We also saw renewed tariff threats via a Section 301 investigation on 16 countries last week. That said, there will be comments accepted till mid-April and public hearings in early May on these probes, which allow room for negotiations and discussions. Last Friday's attacks on Iran's Kurd Island also raises stakes in the war in a very significant manner. The clear implication of the strike is that the site handles almost all of Iran's oil exports, with China being one of the key destinations. Specifically, it is also a reminder that Iran is OPEC's fourth biggest producer. More importantly, should Iran's economic lifeline be damaged, with Trump stating this morning that he is prepared to launch new strikes, it raises the brinksmanship in this war, as there would be little restraint in mining the straits if Iran has little gains left to reap from it. For the week ahead, the FOMC is set for a pause at the upcoming meeting, and rate cuts are likely to be postponed into the later part of 2026 as soaring oil prices unsettle the view of softening inflation. A volatile path to US Treasuries bear flattening is likely as rate cuts are being priced out, but steepening will resume as higher oil prices compounds into longer-term inflation expectations. As for the ECB this week, they are also set to stand pat, but remain vigilant about the threat of higher oil and gas prices sending underlying inflation higher. Meanwhile, in Australia, expectations are significantly raised for the RBA to proceed with a rate hike on the 17th of March, following the previous one in early Feb. While we also call for a preemptive rate hike on inflationary pressures passing through, lofty expectations at this juncture may imply that a tight decision or dovish signals applied about the employment side of their mandate may imply that front-end rates in Australia face slippage risks. In Indonesia, Bank Indonesia is also set to keep rates unchanged tomorrow, with the rupiah being under pressure and the dollar rupiah having tested 17,000 levels last week. All in, markets will certainly work to find an equilibrium in a desire for clarity. That said, even an uncomfortable equilibrium could be disrupted further, as a lopsided conflict stalemate belies an undercurrent of build-up in risks on multiple fronts, from inflation risks, fiscal woes, to outright social unrest due to the prolonged elevation in oil prices. For more information, please refer to our weekly publication or contact your respective sales desk and RMs. And for regular notification on our market views, please subscribe to our channel and hit the notification button. Thank you.